A very good morning to everyone. Let us discuss with the benefits of investing in mutual funds. Now, when we go for different classification, there are multiple benefits under flexible investment tenure, convenient for investor, hassle-free investment, minimal paperwork, SIP assures the power of compounding of your income. It manages the inflation, tax benefits if you invest in the mutual fund. The safe and transparent mutual funds investments are very transparent, though it might be a systematic investment plan. It might be market risk, but investing in mutual funds, all policies pertaining to mutual fund, all these are beneficial one or another point. So let us discuss very briefly about what are the benefits and the drawbacks of investing in mutual funds. So starting with the second slide, investing in mutual fund offers a wide range of benefits, making them a popular choice for investor. Here are the key advantage. See, there are multiple advantage for investor investing in mutual fund, waiting for the short term, long term investment in mid cap or long cap. Right. See, average income can be earned with number of years with the fixed tenure. So this we are going to study in detail and how it is converted into benefiting investor. As in first point, we are going to study about professional management. So this is management, investment management in form of mutual fund. It is managed by the experienced fund manager who analyze and select the investment, and he save the time effort compared to managing of your own portfolio. Normally, every investor as a common person or the investor, if I want to invest in any type of mutual fund or any types of stocks, I need to refer some of the experienced person who already into this kind of a business. So especially in mutual fund, there are fund managers, mutual fund manager or financial managers who look into, who analyze the investment, who analyze the portfolio, who convert that portfolio management into profitable business for the investor, and he chooses investment plans. He just go for referring which investment plan is better and how long this investment can be kept in hand and how long profit can be expected. So he might be saving the time or effort compared to managing your own portfolio. So coming to the professional management, so basic introduction is the professional management. Mutual fund offers investors opportunity to earn income or build their wealth through professional management of their investable funds. So mutual fund always they just go for uh, kind of investable funds to create more and more wealth through different types of opportunity in investment. So manager will help to invest in various avenue. At the same time, you have several aspects of professional management like investing in line with the investment objective, investing based on the adequate research, or ensuring the prudent investment process are as follows. So there are multiple classifications where investments are classified, getting benefited, uh, making different classification based on what investing with the security market required the investor to open and manage multiple accounts, relationship brokeraging of account, demat account, right? All these are professional manager, especially the fund manager. He will clearly guide how things can be managed and what are the purpose of managing in different point of view. Then fund management functions is not restricted to research and selection of security. So here there is a calculation of NAV, publishing of NAV daily basis means accounting of entire portfolio. You have a net asset value daily base. They just go for calculate and they just compare between your previous profit to the current profit. Then comes about diversification, what we call affordable portfolio diversification. Normally, everyone knows that in mutual fund, investing in one particular basket, you invest in many multiple basket where it will yield a different return. If one basket is empty, another basket somewhere off, another basket might be full. So instead of losing entire money, you might balance between basket which are full of asset or full of profit. So diversification here invest across a wide range of assets in the stock, bond sectors or geography or reducing risk or minimize the impact of poor performance in the single asset. So diversification always the second point what you are seeing here. it will minimize the impact of a poor performance in any single asset. So here, investing in unit scheme provide investors to explore a range of security, and I can tell you the investor can get a proportionate ownership diversified investment portfolio, a small investment rupees 500 mutual fund scheme. You can start investment doing with a small amount of rupees 500 into multiple different mutual fund schemes. Then diversification of investor assures all the eggs are not in the same basket. It's so simple. All the eggs are not in the same basket. So consequently, investors would like to share the money in different projects or different instruments. It might be equity form, it might be debt form, or same in time of diversification. It will reduce the risk, and comparatively, it will see that where exactly the investments can be made. Then, in order to achieve the level of diversification, investor will need to in several lakhs or several money which has to be invested in form of less 1,000 rupee. Now you might be investing in the small money or the large money, but you should know how it has to be diversified. So one of the portfolio diversification which is called affordable diversification, affordable investment diversification. So we'll see the next as a third advantage is an accessibility. The accessibility suitable for all type of investor from the beginner to expert, access to get invested to get return, start investing with the small amount through systematic investment plan, that is SIP. One of the advantage, I will give an example. Even I invested in 2009-10 with one of the mutual fund starting with 500 rupees, and today I can see it has appreciated more than 1000%. So a small amount of 500 and a systematic investment plan where there is less risk and less profit also can be expected. But you should know that keeping the same amount for the long run, it will yield or fetch different types of return, where for the every beginner, one advice, the expert advice will be start from small amount and just invest, diversify in multiple way. The same 500 rupees can be diversified in different types of stocks or mutual funds, and you can go through for the various improvement in the same amount year after year. So accessibility, one of the aspect here. So accessibility talks about in the large economic scale how systematically investment will help you to gain your capital gain, capital appreciation in year after year. Then the fourth one is the liquidity. When we talk about liquidity, we should know that easy to buy, easy to sell most of the mutual fund, offering quick access to your money. So you bought today and you can sell. You can convert that your funds into cash at any time. So exception include funds with the login period. So you have very clearly how earning types of stocks, right? Less risky when it's come for you buy with the liquidity, invest the financial market, are stuck with the security for which can't find a buyer or worse than compared to any other market. So investor mutual fund can recover the market value investment so easily. So for the mutual fund itself, material development take place related to investment in mutual fund schemes, and liquidity easy access, easy convertible at any time. So combination of transparency, liquidity enhance the safety. So one classification can be said that combination of transparency and liquidity enhance the safety of your investment. So every investment manager would like to help you what type of access free and what type of liquid can be converted into which amount or how many years login period. And the next is the tax efficiency. Coming to this slide, tax efficiency. Certain funds are tax deferral. You can call tax deferral year after year. These benefits are availed, like certain funds like equity linked savings schemes. ELSS, equity linked savings schemes, provide tax benefit under ATC. Capital gains are a tax favorably compared to other investment instruments. So if you see, mutual funds are not liable to pay tax on income they earn. If the same income were to be earned by investor directly, the tax may have to be paid by the same financial year. But here, mutual funds are not liable to pay tax. You should know that also. Then mutual fund offer options, like investor can let the money grow in the scheme for several years. And selecting such options possible for investor for defer the tax liability. So you can pay tax now or later on. It depends. It depends how tax can be paid and how tax can be reimbursed in future days. So they help the investor legally build the wealth faster than would be in case so pay tax on income each year. So see, when it's come for tax efficiency, every income has to pay tax, but even after that, if you see, your tax can be deferred, if not now, for the later days. Why? Because year after year, if you keep that mutual fund for a longer period, with that income, you need to pay the tax just now. You can pay in the later year once you go for withdrawal. But mutual funds are much beneficial than the stocks. So it might be under a short duration, short period, profits are very less, but in the long period you can expect more profit rather than any other revenue. So it's a risk free, but somewhat you need to wait for the longer period. That's what I said, that in a fund manager will help you to, or he will guide you where to invest exactly, but he will also tell you how login period or how many years you need to keep the same money. Then you have variety options. Now, in variety options, you have a convenient option, investment comforts or regulatory comfort. So, variety options, a wide range of funds are tailored to different investment goal, risk level, time horizons. Example: equity fund for growth, debt fund for stability, hybrid fund for balance. So, say one of the options I can tell you here, like if you're talking about the variety of wide range options, here, it have been said that investment goal, risk level, time horizon, equity fund for growth, debt fund for stability, hybrid fund for balance. So equity, you keep equity for the longer period and 100% you will reach one level of growth which is expected. When it's come for debt fund, you have a fixed income and there is specific login period. It might be 5 years or 10 years or 15 years. You might go for investing in the debt, but login period will be very uh, flexible, where it's come for might be with the duration of one fixed tenure where you can make with a stable income. But when it's come for equity, you need to wait for the growth level. It might take long period. But hybrid fund for the balance, so because hybrid itself the combination of debt and equity, so it will balance your money, one side with the growth, another side with the stability. So both are component here, both are converted into uh, creating the money which has been invested by the investor. So coming to the seventh one, it is also said that cost effectiveness. A cost effectiveness. One of the advantage of investing in mutual fund, lower transaction cost due to pooled resources, because mutual funds are invested in the pool, and it is a pool of many investors' money, of many investors as invested. That's why it is comparatively lower transaction cost compared to equity. So when it's come for mutual fund, a transaction cost itself is minimal, not like any other instrument where you raise the funds but you need to pay extra fees. But when it comes for expense ratios are regulated to ensure they remain investor friendly. So expenses, that's what I said, that here the expenses or the cost, what we call in the mutual fund, are relatively lesser than the other instruments or equities. Then you have eighth one is the transparency. This is one of the area where mutual funds are very clearly regulated by SEBI. So Security Exchange Board of India, fund regulated by authority like SEBI, and regular disclosure on portfolio holding, performance and expenses. So the transparency, it's very clear. the fund is allocated to whom, fund investment done by whom, and how long these funds are there, and what are the transaction, and the authority like SEBI itself is monitoring, and it will enrich the safety of every investor's investment, fair practices in the market, and will disclose the portfolio holding with the appreciation or depreciation and the performance and expenses of an entire transaction. So all these are very transparent when it's come for classification of mutual fund. Then coming to one of the benefit, it's in a systematic investment and it has an easy withdrawal. Like you need not to wait for any buyer and seller concept here. So you buy mutual fund today if you think really market is doing good and you can wait for the longer period, then you need to wait for the longer period, you'll withdraw in future dates. But if you think that market was good and I can say the next some odd days market is not going to be worst by multiple reason, so I might decline my investment, I might withdraw from my investment. So here SIP allow disciplined regular investing to build wealth over time. So SIP always allow investor to be disciplined in investment plan, regular investing into build wealth over time. Then in systematic withdrawal plans, we had SWPs, provide steady income stream during retirement. So you have a lot of retirement plans too. Normally a small amount of 500 rupees is starting from age of 25, and if you keep up to your retirement, the next 35 years or 40 years, drastically you can see the money which has been pulled into market and the return expected. So it has a systematic withdrawal plan provides steady income stream during retirement. Then the flexibility, freedom to switch between funds within the same fund house, option to lump sum investment or regular contribution. So there is a flexibility investing in different form and freedom to switch between the funds within the same fund house. You can switch from if you invested for 5 years and the 5 years is the login period, and now you want to stop this and you've gone through for one more investment, new investment, where your money whatever funds in the pool is there that can be reinvested once again in the new plan. So freedom to switch between funds within the same fund house, and options of lump sum investment or regular contribution. So one of the advantage, one of the flexibility, you can uh, contribute your investment either in form of a partially with a small amount, or you can invest in lump sum investment or regular contribution too. So lump sum investment is much better and the faster return rather than the small amount, but small amount is safer than the larger amount. So this is how it is classified under flexibility. And coming to the last slide here, you have a compounding returns, like reinvestment of returns can significantly boost wealth over the long term due to power of compounding. So you might be, I said already, you might be invested your 1 lakh rupees in 2010, and in 2020 you might be saw it is a 100 times more than what you invested, and the same money, if you want to keep in the same company with the same option, or you can reinvest with the same amount, might be 1 lakh converted into 10 lakh. Now the 10 lakh plus you want to reinvest the 10 lakh upon that somewhat lakh rupees. So this what the compounding talks about, it will boost the wealth for tomorrow. So this is what the classification of compounding interest. Then about the risk management. So here investor can choose funds aligned with their risk tolerance, low, medium, high. So I said we have started with the fund manager. Fund manager always uh, precise you about that where exactly you can invest, or which risk has a high tolerance and zero tolerance or the low tolerance. So here he might help about investment in the form of a low, medium, and high. You invest in the low investment plan, investment in the medium investment plan, or high investment plan. So risk also high, where investment profit is high or return is high, low return, low profit, medium, and average balance. So professional fund manager actively mitigate all type of such risks. He might guide you, he might help you Exactly. So only thing is about you should know that where, how, which time I need to invest. Whether market is good, you invest there, or market you're waiting for the market to come down, you're trying to get invested there. So only thing is that a good experienced staff, good experienced manager always actively participate and try to mitigate your risk profile, which is attached to the investment. So thank you all. We'll see our remaining class in the next chapter. Thank you.